The market for Interpublic Group of companies has officially closed its final chapter, ending its run on the New York Stock Exchange at a fixed price of 24.57 USD. If you are looking at your screen right now, expecting to see the usual intraday market movement or a ticking chart for IPG, you're looking at a ghost. The stock you're searching for no longer exists in the form you once knew. As of this morning, Friday, November 28, 2025, Interpublic Group has been delisted, removed from the S&P 500, and effectively swallowed whole. While the final print on the tape reads 24.57 USD, the reality of what is sitting in your brokerage account is far more complex and, frankly, much more interesting than a static closing number. You are no longer holding shares of a struggling ad agency fighting for scraps against big tech. You have been involuntarily transitioned into a new reality. If you open your Fidelity mobile app or check your balance on the Robinhood app right now, you might see a frozen figure, but the actual live value of your capital is now tethered to a completely different ticker, Omnicom Group, which is currently trading actively around 72.40 USD. This is the classic tension between expectation and reality that catches so many retail investors off guard. The expectation was that IPG would continue to trudge along as a standalone entity, perhaps paying its dividend and slowly bleeding out against the digital duopoly of Google and Meta. The reality is that the industry has capitulated to consolidation. The merger that we have been watching in slow motion since late 2024 has finally crossed the finish line. The European Commission gave its unconditional approval just days ago, the deal closed on Wednesday, and today, SanDisk has officially replaced IPG in the S&P 500. If you are a passive investor engaging in self-investing through Schwab Intelligent Portfolios or a similar automated service, this change might have happened without you even clicking a button. But for those of you managing an individual brokerage account, you need to understand the mechanics of what just happened to your money, because the arbitrage spread has officially closed. For every single share of IPG you held, you are now the owner of 0.344 shares of Omnicom Group. Let's do the math together so you can see exactly where you stand. If IPG closed at 24.57 USD and you swap that for 0.344 shares of Omnicom Group trading at 72.40 USD, the implied value of your new holding is roughly 24.90 USD. You effectively made a gain of about 33 cents per share just by holding through the delisting. It is a small victory, but in a market obsessed with high-flying volatility like NVIDIA stock or the erratic swings of Tesla stock, these boring structural arbitrage wins are often where the smart money quietly compounds. You didn't have to chase a breakout, you just had to understand the deal terms. This is why paying attention to the fine print matters, whether you're using high-end tools on the Interactive Brokers platform or just casually checking your portfolio on SoFi Invest. But why did this happen? Why did one of the legendary names in advertising, a company that owns massive networks like McCann and FCB, essentially give up the ghost? To understand this, we have to look away from the stock price and look at the macro environment that crushed the traditional ad holding company model. For the last decade, companies like IPG and WPP have been in a slow-motion car crash with Silicon Valley. Every dollar that used to go to a TV commercial or a billboard is now being algorithmically funneled into the walled gardens of search and social. IPG was simply too small to fight a war on two fronts, one against the tech giants stealing their lunch, and another against the consulting firms like Accenture that are stealing their dinner. The expectation from the street was that IPG could pivot to data, buying companies like Acxiom to bolster their tech credentials. The reality was that they couldn't scale fast enough. Omnicom, by acquiring IPG, is making a massive bet that size is the only defense left. They are creating a super holding company, a behemoth that can arguably sit across the table from Amazon or Netflix and negotiate better rates. If you are holding these new Omnicom shares in your Fidelity IRAs or your Fidelity brokerage account, you are now part of the largest advertising entity on the planet. The question you should be asking isn't, why is IPG gone, but is Omnicom a good investment now? This is where the analysis gets critical. Omnicom is trading at a price-to-earnings ratio of roughly 11 times, which is bargain basement pricing compared to the tech sector. If you were looking at Apple stock, you're paying a premium for growth that might not be there. With Omnicom, you're paying a low multiple for massive cash flow. This merged entity is going to be a cash cow. They're going to cut costs ruthlessly. That is the dark side of mergers that nobody likes to talk about, but it is the reality of corporate synergy. Duplicate back-office roles, redundant real estate, overlapping software licenses. All of that is going to be slashed. For the shareholder, that means margin expansion. For the industry, it means a shrinking job market. Let's talk about the specific price action we're seeing in Omnicom today. The stock is up over 1% intraday, hovering near 72.40 USD. This tells us that the market likes the completion of the deal. Institutional investors, the big funds that move markets far more than anyone using Robinhood fractional shares, are signaling that they believe the integration execution risk is low. They're not selling the news, they're buying the combined cash flow. We're seeing volume on Omnicom spike today as index funds that track the S&P 500 rebalance their portfolios. Remember, IPG is out, SanDisk is in, but Omnicom's weight in the index just got heavier because its market cap effectively swallowed IPG's. This creates a forced buying pressure that provides a nice floor under the stock price right now. If you are sitting in cash in your Interactive Brokers account thinking about where to deploy capital, this new Omnicom entity offers a compelling yield play. The combined dividend yield is likely to remain attractive, hovering near that 4% mark, which is significantly better than what you would get in a standard savings account or many government bonds. However, we need to address the elephant in the room: artificial intelligence. The expectation is that AI will destroy the ad agency business model because you won't need human copywriters or art directors anymore. You can just ask a generative model to make a funny beer commercial, and it spits it out. If that expectation is true, then holding Omnicom stock is like holding shares in a horse and buggy factory when the Model T is rolling off the line. But here's the contrarian take, the reality that might actually make you money. AI creates chaos. It creates a flood of mediocre, fake, dangerous content. Brands are terrified of their ads running next to AI-generated hallucinations. They need a custodian. They need a guarantor of brand safety. The new Omnicom IPG giant isn't selling creativity anymore. They're selling curation and safety. They become the premium filter that ensures a Fortune 500 company doesn't destroy its reputation with a rogue algorithm. If they can position themselves as the safe harbor in the AI storm, this stock at 11x earnings is a steal. Now, I want to hear from you because this is a massive shift in the market landscape. Comment below how many shares of Interpublic Group you were holding when the music stopped. Did you even realize the merger was closing this week? Or did you wake up to a surprise in your account? I read every comment, and I'm curious to see how many of you are planning to keep the Omnicom shares versus those of you who are just going to dump them and move into something like crypto on Robinhood Crypto or a tech ETF. Let's look deeper into the mechanics of what happens next for your account. If you use a platform like SoFi Invest or seek investment help through Fidelity Wealth Management, the conversion process typically takes a few days to settle. You might see a temporary placeholder symbol or a corporate action notification. Do not panic. Your money hasn't vanished. It is just being redenominated. However, there is a tax implication here that you need to be aware of. While the stock-for-stock exchange is generally tax-deferred, any cash you receive in lieu of fractional shares is a taxable event. Since the exchange ratio is 0.344, it is mathematically impossible to have a perfectly round number unless you held exactly 1,000 shares, 2,000 shares, etc. Most of you holding odd lots will get a small cash deposit for the 0.8 or 0.2 of a share you couldn't convert. It's minor, but when you're doing your taxes next year, don't forget that small realized gain. It's these little details that separate the amateurs from the pros who treat their Interactive Brokers trading setup like a business. Comparing this to other opportunities in the market, the risk profile of this new Omnicom entity is vastly different from the high beta names. When you invest online in something like Tesla, you're betting on a visionary